Hi, welcome back. In this session, I'd like to talk about a question that we've been debating in finance for the last 50 years. And the question is whether you should be a passive investor, an investor who puts his money or her money into index funds and ETFs and essentially tries to match the market, or whether you should actively try to beat the market by picking stocks and trying to time markets. That question, of course, was brought to the forefront by Professor Gene Farmer at the University of Chicago. Now, I got to be Gene Farmer's TA when he came out to UCLA in the early 1980s to get away from the Chicago winters. And I've been following his work right from the beginning. Now, Gene, of course, laid out the foundations for efficient markets in a 1971 paper that essentially is the basis for why he won the Nobel Prize in 2013. Interestingly, the year that Professor Farmer won the Nobel Prize, he was paired with Professor Schiller, who happened to be, in a sense, the opposite end of the spectrum in terms of thinking about markets not as efficient mechanisms, but as mechanisms that sometimes create very large bubbles. Now, I won't give away where I'm going to come down on this divide, and I'd like to plead that you don't prejudge me. Your reaction might be, he's an academic. I know exactly where he's going to come down. I might surprise you. But let's start by looking at why this question has become so much more critical in the last couple of years. The very start of passive investing can be traced back to Jack Bogle creating the Vanguard 500 index fund in 1975. That initial fund, that when he started, people said, there's no way this is going to work against all those people who professionally manage money. And of course, he's at the last laugh. Because not only has Vanguard become one of the largest fund families on the face of the earth, but other people have started index funds. And over time, if you add exchange-traded funds to the mix, passive investing has taken off. And to show you how much it's taken off, let's just look at the growth of passive investing relative to active investing, especially since 2005. So in this graph, you can actually see how much of and this is just for institutional money. How much of institutional money takes the form of passive investing and how much takes the form of active investing each year from 2005 through 2016. And in addition, you see the percentage of the money invested by institutions in passive and active vehicles each year. And as you can see, the percentages have been climbing they go from less than 20% to almost 40%. Passive investing has doubled its share of institutional investing in the last 11 years. Now, this, of course, is also backed up when you look at the flows of funds into and outside passively managed funds and actively managed funds. So if you look since 2005, you see funds flowing out of actively managed funds and flowing into passively managed funds. So this is no longer a debatable phenomenon. Passive investing is clearly winning, and it's winning big. And the question then becomes why it's happening. I think that the best advertising for passive investing is the performance of active investors. And let me back that up. It is impossible for active investors to collectively beat the market. That's absolutely true. And here's why. Let's play a little game. Let's assume that 40% of the market is passively invested and 60% is actively invested, which is pretty close to where we were in 2015. Collectively, passive investors match the market, right? So even if you net out those very minimal transactions costs, they're basically matching the market, which means that the remaining 60% at best can match the market, but given that the active investors have much larger costs, they will have to underperform the market by at least their transactions costs. You're saying that's a very negative view to take of active investing. Well, the numbers actually back me up. Here's the first piece of evidence. This actually looks at returns made by actively managed funds against their passive counterparts. So I'm not measuring all of them against the S&P 500. So if you're an active value investor, I'm going to measure you against a value index fund. An active growth investor against a growth index fund. In other words, I can create a passive vehicle that matches almost any active strategy. And this graph looks at the returns that active investors have made relative to their passive counterparts over the last year, the last 3 years, the last 5 years, and the last 10 years. Let's take the last year. In the last year, which is 2015, passive investors made 0.99%. Active investors made minus 1.93%. That's a difference of 2.92% between active and passive investing. And if you look at the last 3 years, Active investors made 12.12%, passive investors made 14.9%. That's a 2.78% underperformance. Even if you go to the entire 10-year period, 2006 through 15, active investors on average each year have made 6.2%. Passive investors have made 7.41%. On an annualized basis, active investors have underperformed their passive counterparts by 1.21% a year. So active investors collectively cannot beat the market. This is also borne out when you look at the percentage of active investors who do better than the market each period. And I've actually looked at 3 different markets here: the equity markets, the bond market, and the real estate market. In every single market, you find that active investors underperform the market. More than 50% of active investors deliver returns low in the market. And for equities, it's as high as 70, 75, or 80%. In fact, the only outlier here was bond funds in 2015, where active bond managers managed to beat their passive counterparts about 70% of the time. But as you can see, even bond investors, if you pulled out the time periods, don't seem to beat the market. So that's the first piece of evidence as to why active investing is losing out to passive investing. Collectively, active investors can't beat the market. Now, if you confront active investors with this, their argument will be, but these are all active investors. We're one of the good ones. So if you look at active investors, there are always groups that claim to be the chosen ones: value investors, growth investors, small cap investors, investors based on momentum, investors who are based on data. So their argument is, while collectively active investors don't beat the market, that their particular subgroup does beat the market. Is that true? Well, let's look at the evidence again. This is from S&P, where S&P looks at the percentage of managers in each style who outperform the market and the excess returns they earned relative to the market. Every single style category, growth, core, value, and across all active investors, small cap, mid cap, large cap, every single one of them, you see red. Red in what sense? You had negative excess returns. You earned less than what you'd have made with a passive investment. So the way to read this, if you're a small cap growth investor and you try to pick stocks as an active investor, you earn 3.44% less than putting your money in a small cap growth index fund. So every conceivable style class, you see that the passive version beats the active version. You're saying maybe the results are better in emerging markets. Maybe this is why. This is the U.S. Maybe the market's a tough market in the U.S. Well, I have more bad news. If you look across both developed and emerging markets, and this result also comes from S&P, you see the same kind of phenomenon cut across markets. In Australia, Europe, Japan, the U.S., over the 3 and the 5 year periods, more than 50% of active investors have been beaten by the index. It's true, on a single year basis, European and Japanese managers active managers managed to beat the index, but that again seems to be an aberration. If you look at emerging markets, a few possible, positive outcomes show up. One is if you look at India in 1 year and 3 year time periods, but even in India, if you go to a 5 year time period, passive investing beats active investing. There might be a slightly better chance that you will beat the market as an active investor in emerging markets, but the difference is not huge. So at this stage, you're probably saying, well, active investors collectively can't win. No style class wins, but I'm a special investor. What if I found a superstar fund or a superstar manager? More bad news. What I've in this particular table is I've broken active money managers down into 4 quartiles. So if you look at the last year, if you look at the left-hand column, you see quartile 1. So these are from the very best to the very worst managers, from the first to the fourth. And then I track how many of these managers stay in each quartile if I look at the following 3 year period. If you are an optimist in activist investing, here's what you hope to see. If you have a fund that does well, ends up in the first quartile in the last year, you'd like it to stay in the first quartile in the next 3 years, because if you have continuity, then even though active investing collectively doesn't make money, you could find that active investing fund that does well and put your money in it. Well, bad news again. If you look at the diagonal, that's a continuity in this process. There's very little continuity. If, in fact, quartile 1 managers stayed in the same quartile 2 managers stayed in that same quartile, across the diagonal, you should see numbers well above 25%. You don't. In fact, the very best funds in one period end up being more likely to be among the very worst funds in the next period rather than the very best. And that actually shouldn't be surprising. Here's why you end up at the top or the bottom. You take a lot of risk. You either end up as at the very top of the fund heap or the very bottom. There's very little consistency in the process, and that suggests that picking funds based on last year's performance, you're basically chasing last year's performance. You're unlikely to see it in future returns. Now, saying this is true for funds. What if I found a superstar manager? This is actually from a Wall Street Journal graph that looked at Morningstar's top performers in a given year and looked at how they did in the following 2 years. So each year, if you look at the year in which they were picked and you track them in the next 2 years, you see very quickly whether they continue to be good performers. In 2000, for instance, the results were pretty good. They went from great to very good, but they still stayed above the average. In 2001, well, you're catching up. And after 2002 or 2003, you can very quickly see that the very best managers in a particular year are unlikely to continue to be very good, to be among the superstars in the following years. Now, at this stage, you're probably going to fall back on what is the last line of defense for all active investors, and that is to throw Warren Buffett into the mix. I've told people if your argument for active investing is Warren Buffett, you've already lost the argument. Essentially, you can't keep going back to the same well over and over again. I'm not contesting the fact that Warren Buffett has been a great investor, but even Warren Buffett has not been Warren Buffett for the last 15 years. So there was a confluence of things that made him as successful as he was. He's a great investor, but he happened to be at the right place at the right time with the right capital to invest, insurance capital. So if your only argument for active investing is Warren Buffett was able to do it, therefore I should be, you're on really thin ground. So overall, you can see why passive investing is winning this fight. There's very little active investing can bring to the table to convince people that it is generically a better way of investing. So at this stage, let's look at the future. Looking at the contrast between passive and active investing in terms of performance, here's what I predict. I think that active investing is going to continue to shrink as a business. Fees will continue to drop. The profits of the business will shrink. The market share will come down. The business itself will get smaller, which is bad news if you're one of the analysts, portfolio managers, financial advisors, the support staff that go into active investing. To add to the mix, you're getting more disruption coming from the fintech firms. In a post on disruption, I identified the perfect business to disrupt. It would be a big business where there's little value added, where nobody's happy. The people doing the business are not happy. The clients of the business are not happy. That pretty much describes active money management, right? So my guess is fintech is going to have a field day in this. It's going to take a while for it to happen, but overall, I don't see any light at the end of the tunnel that's going to make active investing go back to the way it was in prior years. Now, at this stage, you probably are asking, is there a dark side to passive investing? And there are some potential problems. And here are 3 that have been brought up. The first is as we increasingly turn to passive investors, the Vanguards and the BlackRocks of the world through ETFs or index funds, the question is who's going to manage the store? Who's going to ask managers questions? Because after all, passive investors don't invest any resources in picking the right stocks or contesting management. They just track the market. I would have more sympathy for active investors on this count if they'd been more aggressive in corporate governance before the passive investors joined the mix. But if you look at the history of active investors, the Fidelities, the Janices, the T. Rowe Price of the world, they haven't exactly been aggressive defenders of shareholders historically. They tended to vote with incumbent management almost as often as index funds have. So it is true corporate governance questions will remain a big issue as passive investing continues to grow. But I am a little more optimistic than most people on this front because I think the people who've carried the water for corporate governance tend to be activist investors. Not the passive, not the active investors of the mutual fund or the pension fund variety, but activist investors. The names you often hear, Carl Icahn, the Bill Ackmans of the world, and they will continue to be around, even and especially, maybe more so, as passive investing takes over. The second issue that's been brought up, And this was brought up by Alliance Bernstein in their famous piece where they argued that passive investing were marching towards serfdom, that there would be that the end game here is everybody would be a passive investor. If everybody's a passive investor, nobody will be collecting information. If nobody collects information, markets will become completely random and noisy. I think they've read a paper that many of us in academia have read, written by Grossman and Stiglitz, called On the Impossibility of Efficient Markets. But Grossman and Stiglitz make exactly this point. They argue that you need both active and passive investors. You need investors searching for information. But the very title of the paper also tells you what they think about the possibility that markets could become completely passive. They call it impossible, and here's why. Let's assume passive investing continues to grow, and let's assume the worst case scenarios start to unfold, that people are not collecting information, prices start to become noisy, non-informative. Well, the payoff to collecting information is now going to get greater, right? So the very fact that prices are not informative anymore will mean that people go out and collect information. As they collect information, there'll be more money to be made off that information. So I'm convinced that this will ebb and flow, that we're not going to end up in a game where 100% of investors are passive investors. There will continue to be active investors. They will bear no resemblance, though, to the mutual funds of today, because they will have to actually look for information, not just take public information, feed it into screens, and just pick stocks based on history. And finally, there is this provocative argument that as passive investing grows, product markets will get less efficient. And here's the rationale. Let's assume you end up with 3 passive investors, BlackRock, Vanguard, and some other index fund, and that every company is owned by these 3 investors. The argument goes that because these investors invest based on market cap, that the larger market cap companies will continue to stay large because there will be nothing pushing them down. And the other argument that's made is if 2 or 3 competitors in the same business are owned by the same investors, they will no longer have an incentive to compete with each other because they will think about who owns them and therefore not cut prices and not go after the other company's market share. I don't know where the researchers who come up with these conclusions have been hanging out, but they're not hanging out in the same places I've been hanging out. Because when I look at markets, the fact that you have more passive investors hasn't meant that large market cap companies can't lose 20% of their value over a few weeks. And just because you're more passive investing doesn't mean there's less competition. I'm still to talk to a manager who says, you know what, Vanguard owns 40% of my stock. They don't want me competing with my competitor because they also own 35% of the other company. I've never heard that. Maybe that's happening, but I think it's extremely unlikely. So here's the bottom line. If you're an investor, should you be an active or a passive investor? I don't think that's a question I should be answering for anybody else other than me, because each of us has to work out the answer that best fits us. I think investing is personal. It has to reflect who you are as a person, how much you have to invest, what you bring to the table, and what makes you comfortable. And you have 3 choices. You can be a passive investor and go with the index funds and ETFs that best reflect your risk aversion and kind of come up with a portfolio that manages itself. You can go active, pick stocks, time markets, short term or long term. You can do it off charts, you can do it off DCFs, you can do it off pricing, whatever works for you. Or you can pick a hybrid where you go active to passive depending on the time period, or active on some parts of your portfolio. Let's say your savings and passive on others, say your pension fund. But all I can do, rather than tell you what I think the right choice is, because that's not my place, is tell you what I do. I am an active investor, and I'm sure Gene will be disappointed that I am, but maybe not, because I think Gene Farmer is very much, if you believe in efficient markets, you don't thrust it on other people. I'm an active investor on the portion of my portfolio, but I'll tell you why I'm not an active investor. I'm not an active investor because I have better information than everybody else. I don't. I have no inside information. I never talk to managers at companies. I have no desire to talk to managers at companies. It's not because I can process information more efficiently. Just because I teach valuation and write books on valuation doesn't mean I can do valuation more efficiently or better than everybody else. That's hubris. So it's not because I have better information or I process information or I have special insights into markets. I am an active investor for 2 reasons. I have a client who I completely understand, who gets along with me. That client is me. That is an incredible advantage I have over the typical active investor who has to worry about other people and their time horizons and what makes them happy. The second is I have faith. I've used this word before in the context of investing. I have faith. I have faith in my capacity to value companies. It might be completely misplaced, but I have faith. And I have faith that market prices eventually correct to value. The faith might be based on very little. It might not come true, but I have that faith. But that said, I want to close with a thought. Let's assume that I continue to invest actively and I get to the age of 85 and you look back at my investment returns over my entire lifetime and you show me that the returns I've made by investing actively are actually less than the returns that I could have made investing in index funds. Would I be shattered? No, I would be fine with that. I'm at peace with that. And you know why? Because even if I've earned returns lower than what I'd have made investing in index funds, I enjoy the process of investing. That's why I'm an active investor. And that would be my suggestion to you. If you truly enjoy the process of investing, then be an active investor. Accept the fact that by doing it, you might earn no more or even a little less than you could have made investing in index funds. But recognize that the joy you get out of this process makes up for the difference. I love investing and I will continue to be an active investor. I will do so, though, recognizing that the more active I become, the more danger I expose myself to. So I've got to hold back. I've got to be an active investor, but not too active. And that's all I hold on to in my investing. Thank you very much for listening.